Jamie Dimon said that geopolitics remain the market's biggest risk. Do you agree?
I think I don't know. Maybe in the very short term that's true. But I think, yeah, it's sort of the unknown. It's the ultimate sort of black swan type risk, right? What do you worry about? You worry about nuclear war. You worry about, an obligation to defend Taiwan. You worry about, war between the U.S. and we've gone from a period of, a couple decades of, put aside terrorism, which you can't really put aside, but we really haven't had war between major powers, two countries in Europe in, 80 years. And so this is not a bright time in our history. But we had a period of time where I think Berlin Wall came down and we thought about peace.
So it's a different environment to be investing in for a number of reasons, which we'll get to. How would you describe what your positioning is today?
So similar to what it's been historically, is we own actually really 8 amazing companies. I'm sure you know most of them. We have a tiny little investment in Fannie Mae and Freddie Mac, which I think together represent maybe a little over 1% of the portfolio. But the rest of the those are really options on a ultimate kind of government taking them out of conservatorship. The balance of the portfolio of great businesses we think do well in really any economic, political, or macro environment. And then we opportunistically hedge risks. And the 2 risks we've been concerned about really over the last it's a year and a half, energy prices and kind of the longer part of the curve, the Treasury curve becoming rates moving up.
Betting on the long end of the curve, rates continuing to go up. You nailed that. And you've been making that.
Well, nailed it would be, we put this on like 18 months ago. We haven't made, we actually made almost $3 billion on 2-year rates. We've made a relatively modest profit here. So if nailed it, we would have made more.
But are you still?
I sort of was quiet about it for a while and then sort of made my point a couple months ago, and rates have moved a lot since.
Is it still on, that bet?
It is.
And how long will it be?
Well, until we're right or wrong.
I mean, are you still figuring that rates at the long end, the 30-year, for example, or however on the long end, are still going to go higher?
Yes. Look, I think there's, even in the relative short term, there are a number of reasons why rates can move a lot. Among them, right, we have a government shutdown. We're going into what looks like a highly probable government shutdown. We're going to have a data shutdown, right? All these little government agencies that put out data that the Federal Reserve relies on to decide whether to, adjust interest rates, they're going to lose access to that data. So we're going to have this sort of kind of dark period. We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own any U.S. securities anymore, selling. We have Saudi Arabia selling. And we have an economy that is still strong and inflation, 3.5%, 4%, and persistent. But, our view is basically you're not being paid enough to enter into a 30-year contract with the U.S. government at a fixed price. 4.7 or wherever it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term. We went through this very unusual period with extremely low interest rates, where everything just got cheaper. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. The aspirational goal is to get to 2% inflation, and then the pandemic, and trillions of fiscal stimulus, the psychological stimulus of being free to roam after being locked up. All of these factors coming at once kind of lit inflation, and we still have this massive deficit spending. We still have infrastructure spending. The government's selling literally hundreds of billions of dollars of securities, bills, and at some point they're going to have to sell more and more of the longer instruments. And if you look at the balance sheet of the Federal Reserve, it's an imprudent balance sheet. If you think about the United States, right? If this were like a business, you wouldn't have so much short-term. You wouldn't have a third or more of your debt repricing within the next year. So it's not been managed. I think actually Steve Mnuchin did a good job as Treasury Secretary. The one thing he missed is he should have issued a lot of 30-year, 50-year, 100-year paper at crazy low interest rates, and that's going to be a burden.
Hearing a lot from investors these days. Ken Griffin was on our network within the last week or so. I just had a conversation with Rick Reeder of BlackRock. Those who are talking about the possibility of much higher real rates for much longer than people think, for the very reasons that you're talking about. The issuance is so massive, and where are the buyers going to come from? And the result of that is going to be higher real yields.
I don't know about much higher real rates. I think again, my view is inflation, or kind of the House view is inflation is going to be persistently higher.
Well, you are the House.
I guess I control the door on the way in and out, I guess. But our view is really that we're in a different world. And the world sort of changes gradually. and you have a generation of people who are used to rates, 4 sounding like a high interest rate, and it's, on a historical basis, it's extremely low rate of interest. So I would not be shocked to see, 30-year rates well into the, through the 5 barrier, and you could see the 10-year approach 5.
Jamie
and
Dimon.
that can happen in the very short term, like literally weeks. We've
10
seen
year.
a huge move in the last number of weeks, and I think a lot of that is investors kind of rethinking. What's interesting about the 30-year Treasury is people reflexively buy it whenever they, because they've made money doing it in advance of a recession. But it's really not an instrument you should use to speculate on the short-term economy. It's a fixed price contract with the U.S. government for 30 years and reflects really structural forces. And I think the structural forces have changed.
You must be negative to the equity market.
No.
How could you have a positive view of stocks if you think that that's the outcome for bonds, yields?
Because if you own high quality, the key is owning businesses that have pricing power. Businesses that can do well in a world of, and by the way, many businesses can do well in a world of 3% inflation. The key is it's hard to manage a business in a world where inflation is volatile, or inflation is 8%, or the kind of crazy numbers. But many businesses can do very well in a world of 3% inflation. And the kind of companies we own, they're very much like royalties. So we own Universal Music, which is a royalty on listening to music. If there's music playing out there, Universal's getting a fraction of a penny for every song that's being streamed. Google's a royalty, if you will, on people advertising on the web, right, or on YouTube. Restaurant Brands is a royalty on people eating at Burger King or any of their various concepts. Hilton is I continue, a royalty on people staying in hotels and eating and drinking and going to events. The beauty of these kinds of businesses is, actually inflation is ultimately their friend, right? As long as they can keep their costs, as long as their costs don't inflate as quickly as their revenues. And I think the nature of those, so I feel comfortable owning those kinds of businesses, even if inflation remains high. And also, again, historically, if you think about, what is the value of a business? It's the present value of the cash you can take out of it over its life, discounted back at an appropriate interest rate. We were not discounting businesses back using 2% as an appropriate rate of interest. So we've historically, our discount rate we've used, just rough measure is more like 10%, 9%, numbers which discount the uncertainty inherent of investing in equities.
Alphabet is one of your more recent investments, is that correct?
Yeah, we bought it late last year, early this year.
How much did that have to do with AI?
It had a lot to do with AI because AI was the reason why the stock was cheap, right? ChatGPT was launched, incredible game-changing kind of product, and Google really fumbled their offering. And so people said, oh my God, Google's way behind on AI, and the stock sold off to 15 times earnings for one of the greatest businesses in the world. And we did a fair bit of work, but Google's been almost a decade. They bought DeepMind, huge, spending billions and billions of dollars on AI. It's a company known for hiring great engineers. And you could certainly presume they were in a pretty good place on AI, but they're again very different from a startup. They took a much more cautious launch approach, and then kind of fumbled an early demonstration, made people think they were behind, and Microsoft and ChatGPT would sort of, if you will, OpenAI would eat their lunch, and it led to a very mispriced stock. And then we bought more in the 120s. It's our second largest investment.
Alphabet.
Yeah.
Some would suggest that, and it was said on this stage earlier today by somebody who sold Alphabet when the ChatGPT and OpenAI thing came out.
So we bought from them, so we should thank them. Yes.
That the ball was fumbled and recovered by the other team who ran for a touchdown and then piled on with other touchdowns. And now Alphabet may not be able to recover the leadership role that it had.
Yeah, I think that's...
DeepMind is a perfect example of Alphabet having this in-house and still fumbling the ball.
I would say they fumbled the PR around the ball, but I think they've subsequently demonstrated publicly that they are integrating AI in all of their various products. Obviously, the most obvious example is search, and they are, I think, their Bard is certainly neck and neck with ChatGPT, and we think they're if you think about the enormous amounts of access to data that they have by virtue of the various everything from search to the various products they offer to their customers, email and otherwise. Data and the ability to legally extract and train on data is a really important competitive advantage. They also have designed their own chips, access to the cloud, access to the processing power is critical. So they've got many competitive advantages, and I think it's in some ways in an integrated fashion it gives them an enormous advantage. They will be a dominant player in AI for the very long term, we would expect.